Banks are failing, the stock market is pinballing up and down, and the Fed just announced another rate hike of 25 basis points, which brings the federal funds rate to between 4.75 and 5%. But what does this really mean for long-term investors? In this video, I'll be sharing my thoughts on the recent turmoil in the financial markets and discussing some specific stocks that I think are attractive right now given said turmoil. Just to recap some recent events in the financial markets, since the beginning of March, we've seen multiple bank failures, including the venture capital firm Silicon Valley Bank and Signature Bank of New York. Additionally, there's some other regional banks that are struggling, such as First Republic Bank, which seems to be on the brink of collapse, but there are some US banks and regulators that are trying to stabilize that situation. Credit Suisse in Europe also had a solvency crisis and was bought out by UBS. And although the stock market is about flat over the past month, it has been, going up and down pretty quickly over the past week or two following all this startling economic news. And as we can see here, the fear and greed index is solidly in the fear zone, though it was at extreme fear just a week ago. And to top it all off, the Fed just announced that it will be raising interest rates by 25 basis points, which will put the federal funds rate between 4.75% and 5%. And they are probably expecting one more rate hike this year, but no rate cuts until 2024. But ultimately, we want to determine, is this really a big deal for long-term investors, and what should we be doing with our capital as long-term investors right now? And for the most part, I would like to say that we should be doing right now the same thing we've been doing in the past and that we will be doing in the future as long-term investors. But I think there's definitely a few little things that are important to consider when making our investment decisions these days. First of all, there's the ever-present mantra of Warren Buffett, which is to be fearful when others are greedy and greedy when others are fearful. And as we saw, right now seems to be a time of fear and uncertainty. So does that really mean that we should be greedy? I don't really think so exactly. As a long-term investor, I don't think you should ever really be greedy. But what it does mean is that there may be some rare opportunities right now or in the future that could provide a shrewd investor with outstanding returns if they take advantage of that opportunity. And if we as investors can perform the analysis and are confident in our analyses, then we should invest when the opportunity presents itself, regardless of the overall market sentiment. Another thing to consider in this environment of rising interest rates and interest rates that are really much higher than they've been in the past 2 or 3 years is debt. And the vast majority of companies on the stock market that are publicly traded and lots that are private as well, have some debt. So we need to examine that debt and determine if we believe they'll be able to meet their obligations in terms of paying down their debt and paying the interest on the debt in this economy and a future economy that could be much worse, because we really don't know what's going to happen in the future. So a general rule of thumb is that you want to see a company having total debt that is less than or equal to 2 times their net income. This certainly isn't a hard rule to follow, but it's a good general guideline and a good starting point. It's also useful to know when all of their debt is due and what the interest rates are. And all this information is usually listed somewhere in the company's annual report. You can usually find it during some discussion of the balance sheet or debt. And if most of the debt is due within the next few years, then the economic volatility of these next few years could have a big impact on their ability to pay down the debt. But if most of the debt isn't due for, 5 or 10 years, then the next few years won't be that big of a deal. And most likely in 5 or 10 years when that debt is due, whatever economic troubles that come our way in the next few years will largely be past us at that point in the future. And in the same line of thinking as debt is the consideration of a strong balance sheet. Investing in companies with strong balance sheets is always preferred in really any economic situation, but it's even more important in uncertain economic times like we're in right now. Really, the stronger the balance sheet, the more cushion the company has in the case that the business and economy end up performing far worse than expected or running into unforeseen problems. And most major problems generally are unforeseen, so it's important for companies to have strong balance sheets and be prepared for those unforeseen problems. One of the easiest things to look at on a balance sheet is the current ratio, which is the ratio of current assets to current liabilities, and you usually want to see this above 1 and sometimes much higher. But like I was talking about with debt, there's really no hard rules about this. It's usually just a guideline, and just because a company has a current ratio below 1 doesn't really mean that company is in a weak financial position. Another thing to take a look at on the balance sheet is the current portion of long-term debt. And generally, you want this to be a small fraction of the long-term debt, which means that they will be paying their debt down slowly over time, as opposed to having big lump sum payments all at once. So now let's look at some specific companies that I like that have a strong financial position and could be at an attractive price. The first company I want to mention because of its strong financial position is Texas Instruments, ticker symbol TXN. Not only does Texas Instruments have a current ratio that is above 4, they have more current assets than total long-term debt, which you don't see that often, and their net income in 2022 was just about the same as their total long-term debt, so they definitely have a strong balance sheet. But as I explained in a recent video I made on Texas Instruments stock, I think they are a bit overvalued right now. Currently, they're trading around $180 per share, which I don't think is an outrageous price, but I think around $150 per share is where I would personally become more interested in the stock. It's also important to realize as a potential investor in Texas Instruments that they're most likely going to see a drop in revenue and income this year and possibly even in 2024, as the semiconductor industry is kind of heading into a bit of a slump, but that's not really a big deal for true long-term investors. Another company I want to mention on the list is called Robert Half International, ticker symbol RHI. I honestly hadn't heard of this company about 2 weeks ago, and I heard it from one of the guys in the Discord. So definitely join the Discord if you want to hear about new companies. But essentially, Robert Half is a human resource consulting firm that specializes in accounting and finance matters. To be honest, this kind of consulting services company is the kind of company that I don't understand super well, and I haven't done a ton of research on them, but I wanted to include this company because, first of all, I hadn't heard of it before, so I wanted to share it with more people, and I think their financial results and balance sheet are pretty awesome. So right now, they actually have zero debt, which is very rare, and they've been growing their revenue and income very consistently over the past 12 years. Additionally, they have a great track record of consistently reducing shares outstanding and growing the dividend. And as a service and consulting company, they're extremely asset light, which gives them great returns on equity, which have been solidly above 25% for the past 10 years. I'm definitely not knowledgeable enough about a services company or Robert Half in particular to comment on how they will be affected by, the best or worst case economic scenarios that may play out over the next year or two. But I can say that they are in a very strong financial position, so they would have to see a very significant hit to their business to be in serious trouble. And unlike Texas Instruments, Robert Half seems to be at a reasonably attractive price right now. But like I said, I haven't done a ton of research on the company, so I can't really say that for sure. The final company I want to share that I really like right now is none other than Berkshire Hathaway. When it comes to financial strength, size, and stability, Berkshire is one of the best out there. They currently have $32 billion of cold hard cash on hand and another $92 billion in short-term US Treasury bills that can be quickly converted to cash if needed. If you don't know much about the business, Berkshire's main driver of revenue is their many insurance businesses, followed by their railroad BNSF and their utility business Berkshire Hathaway Energy. Additionally, they own many smaller companies that each chip in to provide a small piece of Berkshire's overall earnings. On top of all these great companies, Berkshire owns hundreds of billions of dollars of common stock, including over $100 billion of Apple alone. These common stock investments generate Berkshire close to $10 billion in dividends per year. And they say Warren Buffett doesn't like dividends. I guess he likes receiving them but not paying them out. And lucky for us, Berkshire publishes data on their share repurchases, and in the fourth quarter of 2022, they repurchased shares in the range of $283 to $304 per share in terms of Class B shares. And this means that the stock is very likely undervalued or around fair value right now, because Warren Buffett has stated numerous times that they will only repurchase shares if they believe that the stock is trading at a discount to intrinsic value. So although I try not to worry too much about macroeconomic factors like bank failures, interest rates, and investor sentiments, it's certainly more important now than ever to ensure that we as long-term investors are investing in very high quality companies at attractive prices, so that if things do get much worse, we'll still be able to realize a decent return on our investment. Let me know what companies you are currently looking at that are in strong financial positions and could be at an attractive attractive price, because I am personally always looking for new companies to invest in and just learn about in general. If you haven't already, make sure to subscribe to the channel so you don't miss out on future investing videos. Thanks for watching, and I'll see you all in the next one.